Gino Live, what do we do every day? Every day for about an hour or more, we go over the live agenda. Under the screener, if you hit bull stocks, these are the saved. If you go over here, see bull stocks. This is one of the saved screeners. Bull stocks, bull trends, bear stocks, bear trends. Bull stocks are bull stock picks, bear stocks are bear stocks. These are saved. If you want to copy them, you put a star next to it and you get these quick links like myself over here. And if you want to read about it, you see where it comes from. But basically, we're looking for the doji confirmed with the MACD, RSI above 50, price above 20-day moving average. The sector has to have an RSI above 50, and the weekly sector MACD has to be bullish. That's for bull stock. When you get that, you get a lot of real estate and financial in here, and healthcare. So real estate and healthcare are defensive. And let me turn off my face. Real estate and healthcare are defensive. Financials, some of these are ETFs, is cyclical. And that's really the only three I see here. Now, if I go to bear stocks, we get technology, basic materials, industrials, technologies, industrials, technology, basic materials. So you can see there is some definite difference between the sectors. These are the bear sectors: technology, basic materials, industrials. So as I go through market and sectors, especially sectors, is that what we're seeing over here? Because when I go in here and see my colors on these, is that what I'm going to see over here? Am I going to see bearish on technology, materials? Am I going to see bullish on healthcare, which is over here, and financials? And what was the other one? Real estate. Am I going to see that over here? And real estate is right here. Now, the biggest sector is technology, followed by financials, and then healthcare. And this is growth sector, cyclicals. So your major 11 sectors are right here. Your major 11 right here. And what I'm seeing is a lot of switching around in the different sectors, meaning semiconductors supports technology, communications, discretionary, retail. These are two different trending. They're trending differently. Inside cyclicals, we got some that are bearish and some that are bullish. Like financials is really bullish for a while. Energy is bullish, but industrials and materials are bearish. So we're not seeing what's called a grouping. Usually all of these are green and all of these are red or green. They usually follow each other. But what I'm seeing is mixed. And same with healthcare. I'm seeing healthcare is going back to bullish, possibly. It's still in a slightly bullish trend. And real estate. But biotech's kind of critical. Utilities is bearish and nothing. So it's really mixed. It's really mixed. And this is where we need a catalyst. And then what is that catalyst? That catalyst is we need earnings. It's earnings season. And earnings season is going to shake this out. And it's going to show the investors and traders where the best opportunities are, who's beating earnings, who has better outlooks. And you'll start to see probably by next week, certain sectors taking off that are kind of stuck, like healthcare. Which way is it going to go? So right now, just this morning, I'm kind of interested in AT&T, number one, because of the wheel strategy. Verizon's one of my favorite stocks. Not one of my favorite, just one of my stocks that I like to do the wheel on. And the wheel, when we talk about the wheel, it's for the VIPs that are taking this course. It's one of my darling stocks, the Verizon. But look at AT&T. Here's AT&T. How did it do today? If you go up here to the little sprocket, turn on your earnings. There it is right there. So AT&T came out already. The numbers aren't posted yet. It takes a little while for the numbers to post here. I don't care how AT&T did on earnings. That's secondary. Their guidance is priority, but the chart takes priority over everything. What did the chart do after earnings? It gapped up and rallied down. So no matter what's in the numbers, AT&T gapped up. And, not not a huge move, but for a $20 stock, and it's bottom, it's coming off a bottom, right? It was down at 20, broke 20 and a half and gapped up to 23 and a half. That's a big gap up. And right now it's only up 2.5%, but it was more than that this morning. So looking at that real quickly, what I want to do is I want to show you this little feature on Wall Street IO. You can add up here. There's a crosshair and there's a comparison. You can add up here. What's a company like AT&T? Is Verizon like AT&T? Let's go see. And I can add it there. And there is Verizon. And when you go like this, do those charts look similar? Yes or no? Meaning, do they peak and valley at the same time? Do they peak and valley at the same time? And as you zoom in, like this year to date, see that right there? Exact same chart, basically, the pattern. You see the pattern? And over here is the percentage. You can change that from percentage to price. Now, that's pretty neat over here, right? If you want to see a percent difference or the price, there's percentage, price. And when you go to percentage, it cues it so they both start on the left-hand side over here. Isn't that cool? So like I can say, okay, since it started tanking from the top, here's where they made their highs right there. That's where AT&T made it. Notice how it's the same shape. And can I add another one? We should probably put T-Moose. T-Moose was T-Mobile. Let's add that on there. And what does that look like? Very similar chart, yes or no? Very similar pattern. And let me do this. Let me get off the moving averages here so you guys can really see it. So basically, if they're in the same sector and they're the same kind of company, same industry, telecommunication services, you're going to notice they all move very similar. So why is it important that we know what AT&T did? Because based on the news, we can go read the news and see what happened and all that stuff and find out what happened to AT&T. Was it better guidance? What have you? And they're very similar. If it was a company-specific reason they gapped, that's different. But if you read it and go, oh, they're profiting, they're doing better, most of the time, it gives you a hint of what the other companies like it will do. Does that make sense? So Verizon's down here. So what happened to the options? Well, let me just tell you what happens to the options. Volatility on those options went up last night on AT&T and they dropped. Verizon volatility is going up until Friday. And then what's going to happen on Friday after the open? They're going to drop. So right now, options are cheap on AT&T, expensive on Verizon. With the odds of it following AT&T, you're probably good at selling puts, because selling puts with a high volatility and knowing that there might be a floor in there and AT&T is coming off the floor, even with lower revenue, might be a hint. Might be a hint. And we're going to go into that to the wheel strategy today after the class. About 1:15-ish we kick off. We'll open up the room at 1 o'clock. 1:15 we kick off the implementation for you guys in the wheel strategy. So earnings is a volatility gauge and a hint. For another one, for example, Home Depot and Lowe's. When one of those reports, it's a hint on the other one, right? So you can look at sister companies and start seeing like, okay, if this one does this, what happens? Financials. We had a good kickoff the first week of financials, and how are financials doing? They're all doing good. Most of them, right? How about this? Beverage companies. How about these two right here? This is tomorrow morning. This is tomorrow afternoon. Mining companies. Very similar, right? There's a lot of different examples. So you'll start to find, like, when you're trying to decide between two companies, FedEx and UPS, which one is it? you start to kind of guess what's going to happen. And as the earnings season winds down, Halliburton, how is that going to affect ExxonMobil and Chevron, right? You start to kind of see the picture. Kava, anybody ever eat at Kava? It's a little bit more healthy than Chipotle. And I wanted to bring this one up because when this one broke down, this was a nice trigger. This was a good $4 move here. Let me show you where it was. Here's our doji. We look for the doji. There's our breakdown right there. Or was it here? Anyway, here's where we are now. You want to tighten up your stop loss. And tomorrow, I'm going to go on a special series on trade management and position sizing, if you want to catch that tomorrow, okay? But definitely top, and I like to tighten it up either to the regular candle, and right now it would be on yesterday's high. But if you want to lock in a little bit more profit, you go right here. If you have a put, like 5 contracts, whatever, I'd take one off, move your stop loss to break even, because the goal is to move your stop loss to break even. Stop loss was here, triggers here. That stop loss needs to get right there. And I would say right there is good too, above the Heikin Ashi. The Heikin Ashi is always the middle of yesterday's candle. But look at the difference between the Heikin Ashi and regular candles. If you want to lock in a little more profit, use the regular candle. Pretty cool. Good trade. Kava, one of those expensive restaurants. Remember the saying I told you about? What goes to 90? The first time it goes to 90 goes to 100. Let's see if that's true. And here it is right there. Goes to 90, goes to 100. See that? And the first time it breaks 100, where does it go back to? Back to 90. So here's 100, here's 90, and here's somewhere. Here's the 90 break. So yeah, it needs to stay above 100. If it breaks 100, it comes back. Yeah, so when you get a new company like that, what goes to 90 goes to 100. Does that make sense? And the first time it hits 100 on the downside, it goes to where? So with that said, here is SpaceX. Here's regular candles. We tried to get green yesterday. So the first time it goes to 90, it goes to 100. Will it pan out the first time this hits 100? Will it go to 90? How about that? Because it gapped over 100, but it hasn't seen 100 on the downside. SpaceX still, we're keeping our eyes on this one, guys. Is it forming a bottom or is there another leg down? How many people bought on that first green candle because they didn't want to miss the bottom? Keep your eye on this, guys. There's still indicators developing. Now, CTRE is a trigger here and looking good, like a lot of our real estate. Now, we cut this out of the gate 5 days ago, just as real estate was showing strength in the internals. Trey Todd says, you're saying we should take a chance that if it's 100. So 100 is a very psychological support and resistance level, whether a stock's been there or not. The first time it hits 90 going up, studies show it goes to 100 because, the boardroom, they want to push their stock up to that triple digit just to do it. And then on the way down, if it breaks 100, it's never a good sign. How many people think, Apple ever gets under 100, I'm buying it? It's a psychological benchmark. Time to buy semis, we're going to look at that next. Okay, so real estate is definitely bullish. That was a nice trade we did on CTRE. Why would you not move your stop up on this? Why would you not move it up? Especially if you get a red candle. Your stop, I have some stock gets, or some of my position gets, that's the farthest I would be is a 10 right now. That's the farthest. The closest I would be today's candle. And then somewhere in between, you have Heikin Ashi, which is right about here. Because Heikin Ashi makes it easy to move your stop loss. It's always the middle of yesterday's candle, right? But there's no reason to lose money on this trade. Here's your stop loss. At least get it up to here. Now that, ladies and gentlemen, is an awesome trade for a REIT. A real estate trust. You guys know what these are, right? These REITs. You see these REITs over here? Now, this REIT is a healthcare facility. And I like healthcare facilities because very seldom do you see like big hospital complexes or medical plazas going bankrupt and leaving, right? Like you'll see strip malls and stores inside of strip malls going empty. And you're thinking, God, discretionary retail shops, like, is that the place to be? Can I tell you one of my favorite REIT type places for investors? And this comes from Robert Kiyosaki. Is it healthcare facilities? Is it commercial? Is it residential? Is it strip malls? Is it utility company REITs where they rent out the properties, run their power lines across those nurseries with all the plants growing? You know what's really, really successful? Storages. Like PSA, Public Storage, those kind of companies. And prisons. But no, storages. So when those are undervalued, the storage ones, because whether the economy is good or bad, storages fill up. They fill up. All right, so healthcare facilities, this invest, and what they do is they give you back a chunk of a dividend based on, like a property manager, you get a percentage. I wouldn't want to own a bunch of properties when I look at good REITs. There's some really good dividends in here. And that's our lesson today. When we get into fundamentals, you can start looking at some of these dividends to see if they're healthy, if they have a dividend, right, and what it looks like.